Welcome back to the Deep Dive. Today we're getting into the 2024 Morgan Stanley Shareholder Letter. And this one's pretty important, isn't it? It's the first one from the new CEO, Ted Pick.
Exactly. And, it's significant because after James Gorman's 14 years, a really transformative period, you might have wondered if there'd be a big strategy shift. But this letter, it really confirms the vision is, well, consistent. Still about being that essential, trusted advisor globally, unifying everything around capital.
Okay, so continuity. Evolution, not revolution, as they say. Which seems wise, maybe, given the backdrop for 2023. I mean, it was a challenging year, right?
Oh, absolutely. You had ongoing geopolitical stuff, rates going up faster and higher than expected, made things uncertain.
Tighter credit conditions, too.
Right. And don't forget the regional bank failures in the U.S. It was definitely a tricky environment for finance.
So let's talk about that leadership change. Ted Pick.
Yeah.
He's a real Morgan Stanley lifer, isn't he?
He really is. Started way back in 1990. Investment banking analyst program.
Wow.
And apparently it's the only place he's ever worked.
That kind of tenure, it must give him a unique perspective.
Yeah.
Explains maybe why the core strategy isn't changing dramatically.
I think it speaks volumes about institutional knowledge, yeah. Someone who's seen the cycles, worked across different parts of the business. It really reinforces that whole integrated firm idea.
The idea that the whole is greater than the sum of the parts.
Precisely. That's the strategic pillar.
And looking at the numbers, the model held up okay in 23, all things considered. What were the headlines?
They pulled in annual net revenues of $54.1 billion. Net income was $9.1 billion.
Okay. And the key profitability metric, ROTCE.
Right. Return on average tangible common equity, that came in at 12.8%.
12.8%. So let's pause there. What does that number really tell us, for you, the listener?
Well, it's a core measure of how well a bank uses shareholder money to make profit. And 12.8% in a tough year like 2023. It's solid. Better than some competitors, for sure. But, and this is important, their long-term target, which we'll get to, is 20%. So that gap between the 12.8% they did and the 20% they want, that tells you everything about the growth and efficiency they still need to find.
Right. So let's unpack this glass of one idea more. It links wealth management, investment management, and institutional securities. Why is that combination so important? Why not just run them as separate businesses?
Yeah, the why is really the key insight here. Think of it like this. The structure gives them a kind of resilience, a defense against market cycles.
How so?
Well, the institutional securities bit the investment bank that's naturally cyclical, right? It booms when markets are hot, slows down when M&A stalls.
Sure. We saw that last year.
Exactly. But wealth management, that throws off steadier recurring fees. It's more durable.
Yeah.
So you combine them.
And the wealth management side acts like a shock absorber, stabilizing earnings when the banking side is down.
That's the idea. Scale and durability. It leads to higher and, crucially, more stable profits across the whole cycle. That's the theory, anyway.
Okay, makes sense. And how do they say this integration actually creates value in practice?
The letter lays out three main ways. First, it's about advising their big corporate clients on everything, from C-suite strategy and M&A, all the way down to providing things like retirement plans and financial wellness for the employees of those same companies. That's the workplace offering.
Right, the workplace channel. That sounds like a smart way to feed the wealth management business over time.
It's a huge engine, and that leads straight into the second point. Using those institutional level capabilities to serve individual clients.
So not just the super rich.
Well, them too, the ultra high net worth, but also reaching down, maybe even to self-directed folks eventually. The key is giving them access to things usually reserved for institutions.
Like what? Private equity. Complex hedging.
Exactly. Sophisticated stuff. Bringing institutional power to individual wealth.
And the third piece.
That's about controlling the whole value chain, really, across public and private markets. So they might originate a private credit fund in investment management, structure a big IPO in institutional securities, and then, crucially, distribute both of those through their massive wealth management network.
A closed loop. Sourcing, structuring, distributing, all in-house.
A self-contained ecosystem, yeah. That's the integrated firm vision.
Okay, let's look at the results of that vision. How did wealth management, the WM division, actually perform?
It performed very well, $26.3 billion in revenue for 2023, and the pre-tax margin was strong at 24.9%.
24.9% margin. Good. But you mentioned pressures.
Yeah, that margin was actually down a little bit, mostly due to how interest rates moved around last year, compressing the income they make on deposits, that kind of thing. Shows even the shock absorber feels the bumps.
Still, the growth sounds impressive despite that.
Oh, it was. And this really shows the integrated model working. They added over 600,000 new client relationships.
Wow, 600,000.
And a lot of that growth came from that workplace channel we talked about, converting employees into clients.
And the asset flows. Net new assets.
That was the big headline number, $282 billion in NNA, net new assets.
That sounds huge. How does it compare?
It's massive. It represents about a 7% annualized growth rate on their existing assets. Industry leading, really. This isn't just markets going up, it's new money coming in the door.
And all that adds up to?
$5.1 trillion in wealth management client assets by the end of the year.
Trillion with a T. Okay.
And they're not stopping there, the long-term goal. Push that WM pre-tax margin up to 30%.
30%.
Yeah.
That implies some serious cost control or efficiency gains down the line.
Absolutely. Aggressive target. Now, the other part of this powerhouse is investment management, or IMM.
Right. The asset management arm.
They brought in $5.4 billion in revenue, grew their assets under management, AUM, to $1.5 trillion.
Also huge numbers. What's the focus there?
The letter highlights areas like customization, private markets, value-add credit, the kind of higher fee, specialized strategies that are in demand.
And which they can then push out through the wealth management network.
Exactly. It's all connected.
So if you combine the assets in wealth management and investment management, what's the total scale?
Together, client assets across WM and IM hit $6.6 trillion at the end of 23.
Okay. And the big, audacious goal?
The firm-wide target, stated loud and clear in the letter, grow those client assets to more than $10 trillion.
$10 trillion. That's a staggering number.
It really is. Hitting that target would cement them as a truly dominant global player in asset gathering, and it provides that huge, stable fee base they need to support the whole firm.
Okay, let's switch gears to the third leg of the stool. Institutional securities, IS, the traditional investment bank. How did they fare?
They delivered $23.1 billion in revenues. But yeah, this was the segment that really felt the headwinds in 2023.
Because of the market slowdown.
Absolutely. Investment banking activity, M&A, IPOs. It was just very constrained globally, mainly because of that uncertainty around interest rates.
So what's the outlook there?
Well, the letter expresses quite a bit of confidence. They expect a capital markets rebound as 2024 progresses, and they believe their integrated model, their global reach, means they'll benefit disproportionately when activity picks up.
Banking on a rebound. What if it's slower than they hope?
That's the key risk, isn't it? If investment banking stays muted, it puts more pressure on wealth management to deliver those big margin goals we talked about.
But they do have strong positions even in a downturn.
Oh, yeah, definitely. The letter points out they were ranked NOME 2 globally for announced M&A deals. And in equity sales and trading, they held the NOME 2 spot for revenue wallet share, around 20.4%.
So the franchise is still strong, just waiting for the market tide to turn.
That seems to be the message. Maintaining relevance, ready for the upswing.
And underpinning all of this is financial strength, right?
Yeah.
Capital ratios.
Crucial. Non-negotiable for banks today. Their Common Equity Tier 1 ratio, CET1, was 15.2% at year-end.
Which is good, bad, average.
It's very strong. Well above the regulatory requirements. It gives them a huge cushion, a lot of flexibility to operate, invest, and return capital.
Speaking of returning capital.
They did a lot of that. Returned over $10 billion to shareholders last year. Dividends and stock buybacks.
And you want a single number that shows the firm's transformation over the last, say, 15 years.
Let me guess. The dividend.
The quarterly dividend. Back in 2009, it was just 5 cents a share. Today, 85 cents.
Wow. That's quite a journey.
It really tells the story of building that more durable, integrated model, doesn't it?
And all that performance, that capital return, it feeds right back into the long-term vision, which, importantly, has been formally reaffirmed by Ted Pick. These aren't just Gorman's old goals. They're the roadmap now.
And they are definitely ambitious. Let's run through them again for everyone.
Okay, top line. Client assets over $10 trillion. We talked about that.
Right. Then, wealth management pre-tax margin of 30%.
Firm-wide efficiency ratio aiming for 70%.
Which means keeping costs low relative to revenue. Spend 70 cents to make a dollar.
Exactly. A key operational target. And the big one, tying it all together, deliver 20% ROTCE through the cycle.
Okay, let's be critical here for a second. 20% ROTCE through the cycle. That means averaging 20% in good years and, well, less good years.
Correct.
They hit 12.8% in a tough 2023. Getting to a consistent 20% average, that feels like a huge leap.
It is a very high bar, no question. It requires near-perfect execution on all fronts. Hitting that $10 trillion asset goal, driving those WM margins up, achieving that 70% efficiency, and getting a solid contribution from a rebounding institutional business.
This is a massive challenge. Requires more than just strategy, right?
Absolutely. It needs deep cultural buy-in, and the letter makes a point of highlighting the stability of their leadership. Average tenure on the top committees, over 20 years.
That kind of longevity suggests, well, a strong, consistent culture, institutional memory.
Which you probably need to pull off something this big over the long haul.
They also mentioned other commitments like diversity and sustainability.
Right. They noted women made up 37% of the new managing director class, which is progress, bringing the overall share to 26%. Still work to do there, clearly, but moving.
And sustainability.
A huge financial commitment. Mobilizing $1 trillion in sustainable finance by 2030. That's a big number tied to a major global trend.
And it all loops back to those core values they list, doesn't it? Integrity, clients first, exceptional ideas.
Diversity, giving back. You know, for a firm like Morgan Stanley, projecting that image of being a responsible, trusted advisor is fundamental to the whole integrated firm pitch. It's part of the brand. Hashtag tag outro. So if you zoom out, the big picture here is a firm that spent 15 years transforming itself, building this integrated model. And now, under new leadership, they're saying, okay, the machine is built. Now we make it perform at peak efficiency through whatever the market throws at us.
All right. So for you, the listener, the main takeaway is the strategy is set. It's consistent. It's all about leveraging the scale and synergies between those three core businesses, wealth, investment management, and institutional securities to deliver for clients globally. Okay, so here's a final thought for you to mull over, something to watch based on everything we've discussed from this letter. They've set these really aggressive targets, the $10 trillion in assets, the 20% ROTCE. Achieving that clearly depends on both the steady engine of wealth management and a rebound in the more volatile institutional business. So the question is, which external factor will be more critical to actually hitting those goals? Will it be a sustained, strong recovery in global M&A and capital markets activity? Or will it be the continued, maybe even accelerating push of institutional money into private market products, which feeds both their investment management and wealth divisions? Which swing factor matters more for delivering on that class of one promise? Something to think about.